Imagine buying a company that once traded above $35, only to watch it collapse to under $2. Most investors would assume the story's over. But what if the company quietly rebuilt its business while almost everyone stopped paying attention? What if management eliminated billions in risk, completely changed its business model, and now claims profitability is finally within reach? That's exactly where OpenDoor Technologies finds itself today. The stock is still down more than 30% this year. Many investors have already written it off. Wall Street remains deeply divided, yet insiders are buying shares. Management is making its boldest promises in years, and one earnings report later this year could completely change the narrative. So, is OpenDoor about to become one of the biggest turnaround stories in the market? Or is this simply another value trap disguised as an AI company? Today, we're breaking down everything you need to know, from the financials and valuation to the bull case, bear case, biggest risks, and what could happen next. Let's dive in. OpenDoor's story changed completely. To understand where OpenDoor is today, we first need to understand why the company nearly collapsed. When OpenDoor launched, the idea sounded revolutionary. Instead of listing your home with a realtor, waiting months for offers, negotiating inspections, and hoping financing closed, OpenDoor promised something much simpler: sell your house instantly. The company would make a cash offer using proprietary pricing algorithms, purchase the home directly, perform repairs if necessary, and resell it for a profit. It looked like technology had finally disrupted real estate. During the housing boom, the strategy worked remarkably well. Low mortgage rates fueled demand. Home prices climbed almost every month. Inventory remained limited. Buying homes and selling them a few weeks later often produced attractive profits. Investors loved the growth story. The stock soared. But then everything changed. Interest rates exploded higher. Mortgage affordability collapsed. Buyer demand slowed dramatically, and housing transactions declined. And suddenly, OpenDoor was sitting on thousands of homes that were losing value while financing costs continued rising. Instead of flipping houses quickly, the company found itself paying property taxes, maintenance costs, insurance expenses, and interest on billions of dollars of inventory. The algorithm that looked brilliant during rising markets suddenly became a massive liability. The stock price reflected that reality. After once trading above $35, shares eventually fell below $2. Many investors assumed the company would never recover. But management didn't simply wait for the housing market to improve. Instead, they completely redesigned the business. The capital light strategy. The biggest change at OpenDoor isn't a new product, it's an entirely new business model. Historically, OpenDoor bought every home itself. That meant enormous capital requirements and massive balance sheet risk. Today, management is moving towards what they call a capital-light marketplace strategy. Instead of purchasing every home directly, OpenDoor increasingly acts as the technology platform connecting sellers with institutional investors or third-party buyers. Rather than risking billions of dollars buying houses, the company collects transaction fees while dramatically reducing inventory exposure. Think about the difference. The old OpenDoor owned the house. The new OpenDoor increasingly owns the transaction. That may sound like a subtle distinction, but financially, it's enormous. Software businesses typically command much higher valuation multiples than asset-heavy businesses. That's exactly what management hopes to achieve. If this transition succeeds, OpenDoor could become much less dependent on housing prices and much more dependent on transaction volume. Let's talk about the financials, because while the strategy sounds promising, investors ultimately care about execution. The latest trailing 12-month revenue remains under pressure. Revenue has declined more than 23% year over year. One recent quarter even showed revenue falling approximately 42.6% compared to the previous year. Those numbers aren't pretty. The company also continues losing money. Current operating metrics remain challenging. Gross margin sits around 8.2%. Net margin remains deeply negative at roughly minus 35.25%. Trailing earnings per share stand near minus $1.60. Those are not the financials of a healthy, mature company. However, there are signs the worst may have already be behind them. During the latest reported quarter, revenue actually increased 23% sequentially, reaching approximately $883 million. Sequential growth matters because it suggests business activity is stabilizing, even if year-over-year comparisons remain difficult. That's exactly the type of improvement turnaround investors look for. Management's biggest promise yet. Perhaps the most important statement management has made this year isn't about revenue, it's about profitability. They believe they can become adjusted net income positive by the end of 2026. That's an incredibly bold claim considering current losses. But management argues that profitability won't require a major housing recovery. Instead, it depends on improving something called contribution margin. Their goal is to reach approximately 4 to 4.5% contribution margin during upcoming quarters. That improvement comes primarily from reducing inventory risk while increasing fee-based revenue generated through the marketplace platform. If they succeed, OpenDoor begins looking much more like a software marketplace than a traditional home flipper, and markets often reward that transformation with significantly higher valuation multiples. So why are some investors becoming optimistic again? There are several reasons. First, the business model today is fundamentally different than the one that nearly collapsed. Reducing inventory exposure dramatically lowers financial risk. Second, management appears highly focused on efficiency rather than simply chasing revenue growth. That's an important mindset shift. Third, insiders have been buying shares. Recent filings show net insider purchases totaling more than 232,000 shares over recent months. While insider buying doesn't guarantee future returns, executives generally purchase shares because they believe the market undervalues the business. Fourth, the company continues investing in technology. One particularly interesting development involves OpenDoor experimenting with customer acquisition through AI platforms like ChatGPT. Rather than relying exclusively on expensive search advertising, management is testing whether AI-powered conversations can generate qualified home selling leads at lower acquisition costs. If successful, that could reduce marketing expenses while increasing transaction efficiency. Finally, investors willing to look several years ahead see an opportunity for OpenDoor to become a digital real estate marketplace rather than simply another property owner. That's a dramatically different investment thesis than the one Wall Street was evaluating just 2 years ago. Now, despite all of the optimism, there is another side to this story, and it's a side investors absolutely cannot ignore. Because while management has outlined an impressive turnaround strategy, Wall Street isn't rewarding promises anymore. It's demanding proof. The biggest concern remains profitability. Even after all the restructuring efforts, OpenDoor continues to generate significant losses. Revenue may be stabilizing, but earnings remain deeply negative. Operating margins are still under pressure, cash generation remains weak, and until investors see multiple consecutive profitable quarters, skepticism will likely remain high. Another major concern is stock-based compensation. Management expects roughly $110 million in stock-based compensation during the third quarter alone. That matters because every new share issued dilutes existing shareholders. Imagine owning 1% of a company. If management continuously issues millions of new shares, your ownership percentage shrinks, even if you never sell a single share. That's why dilution becomes such an important issue. For growth companies, some stock compensation is expected, but when profitability remains elusive, investors become much less tolerant of ongoing dilution. Valuation still isn't cheap. Many investors assume OpenDoor must be inexpensive simply because the stock collapsed. That's not necessarily true. One metric investors continue watching is the company's price-to-book ratio, currently 4.2. Price to book compares the company's market value to the value of its underlying assets. A ratio above 4 means investors are paying more than 4 times the company's accounting book value. For a business still losing money, that's not exactly a bargain. Supporters argue investors aren't buying today's assets, they're buying tomorrow's software platform. Critics argue the valuation still assumes execution that hasn't yet been proven. That's why opinions remain so divided. Housing still matters. Management says profitability doesn't require a major housing recovery. That may be true, but housing conditions still matter. Mortgage rates remain elevated. Housing affordability remains historically difficult. Housing transactions across the United States continue operating below long-term averages. Even if OpenDoor becomes more efficient, fewer housing transactions naturally limit growth opportunities. That's a challenge no software improvement can completely eliminate. In other words, the company has reduced its dependence on housing prices. It hasn't eliminated its dependence on housing activity. Volatility remains extremely high. Another factor investors should understand is